This range here, what is this? It's a buy side imbalance, sell side inefficiency. It's inefficient in the sense that it's not offering much in terms of sell side, listen, sell side delivery. That means the market needs to offer prices going lower. And we get that with this candlestick over here, where it goes down. This inefficiency, you're going to find the real support resistance. It starts moving lower, it attacks the sell side, and it goes down and trades beyond this buy side imbalance, sell side inefficiency. So what's the algorithm going to refer back to? This level, the lower quadrant, consequent encroachment, which is the midpoint, upper quadrant, and then the high. The market trades here yesterday, or what was that? Yeah, Tuesday. Trades up into it, bumps it. One more time yesterday, boom, displacement lower. See that? That's not random. And they won't be hidden from you. You won't be so inclined to say, well, you know what? I see this market's rallying up in here. You know, it might take this high out here. I'm bullish. It's going to go up in here and trade into this sell side imbalance, buy side inefficiency. Why should it do that? Because it's already shown a willingness to go up there and reject. And then we opened here. We trade back up. I'm looking for the midpoint and a failure and not get above that high. Why? Because it's already overshot this buy side imbalance, sell side inefficiency. So inside of this little area, all close proximity on lower time frames around the 17,954 or thereabouts, you can look for premium fair value gaps to get short or up close candles to be treated as my bearish ICT order block. You do not look at a down close candle above a high that's been broken and wait for it to trade back down into it and think that that's going to support the price and go higher. Don't do that, especially when the market's underlyingly bearish. It's not going to happen. So you have to look at how the market creates these inefficiencies, because the algorithm will go back to those levels and offer one more instance, because it's already done the work of going up here. And what's it lacking on this candle? Between the ranges of 18,192 and 17,954, it's only offered on this time frame what? Buy side delivery, not liquidity. Listen to what I'm saying. It's offering buy side delivery. That means momentum and delivered higher prices. So because it's only this single candle that's traversed from the previous candle's high to the second or the next candle's low, this range has only been traversed by that one individual candlestick or one day. Because of that, anytime we get into it here, if we're bullish, that's an area where we can anticipate what? Down close candles on smaller time frames. That would be my ICT bullish order block. Or on smaller time frames, short-term lows that are taken out, as long as it's the right time of day, they could be turtle soup long entries. Or you can wait for a smaller time frame displacement in price where it takes out a short-term lower time frame high that leaves a fair value gap. When it trades back down to the fair value gap, you buy that, because you're trading with this idea that it's gone down into this inefficiency. And as I taught in the mentorship lessons, if you measure this right here, watch, I'm going to pull a fib up. If you're bullish, inefficiencies that are, like in this case here, we're defining this one, the best place for the entries on longs are not, listen, they're not in the lower half. Why? If it's bullish, it won't want to come back down here. That's what you really want. That's a signature and price delivery that you really want to have that. So it's better for you to look for the long between this candle's low, which is the high of that buy side imbalance, sell side inefficiency, which is a fair value gap by classification. But specifically, it's buy side imbalance, sell side inefficiency, meaning it's an up close candle. And the best buys will form consequent encroachment, which is the midpoint of that inefficiency, to its high. Look at the sensitivity and price right here. Look at that. That's near perfect. And because they created what? Relative equal lows, what does that look like to a retail trader? Oh, that's a double bottom. We can put a stop loss and go long. Oh, okay, we got you there too. And then it takes the higher high out. When we have this, we cannot, listen, look at the down close candle here and think, okay, when it trades back down there, I'm going to go long. Because what you've done is insisted upon the market now has to bend to your will and make even a higher high here, when it's already done so with that high being taken there. This has now been exhausted. It can trade down there and have a little bit of a reaction, but you're gambling doing that.